Bismillah ar-Rahman ar-Rahim. Inshallah, today we'll talk about the types of leverage. Normally we know one type only of leverage, which we call it financial leverage. Or some professors, they call it financial power, because sometimes we know that the leverage is a power. Today we'll talk about financial leverage, operation leverage, and compounding leverage. It has a lot of meaning. So first I will start, how can we calculate each one? Second, I will talk about what is the effect of each one on the earning per share. You have to recognize that normally I'm talking about the earning per share, which is the most important item on our balance sheet and income statement, and it is considered by the owner. And normally when we evaluate the performance of any management, we have to see the effect of this management on EPS, which is the earning per share. Okay, so first you have to know, okay, I can explain the three types of leverage from the income statement. Remember the income statement? We have income statement which starts with the sales or revenue. We have to deduct the cost of goods, which is COGS. The remainder we call it gross profit. By deducting the fixed cost, we have EBIT, which is earning before interest and tax. Deduct interest, we have earning before tax. By deduct tax, we have net income. And by dividing the net income on number of shares, we have EPS. Okay. The operating leverage measures the relation between the gross profit and the EBIT. Which means, if you see, the difference between those is what? Is the fixed cost. So you have to know that the main drive for the operating leverage is the fixed cost, which means also by increasing the fixed cost and at the same time decreasing the variable cost, your profit will be increased. Again, by increasing the fixed cost and decreasing the variable cost, which means by replacing machine instead of worker, you will increase your profit. This is the meaning of operation leverage. Also, by rely more on debt instead of partners. So if you need money, instead of getting money from partners by issuing shares, and instead of that, you can get the money by taking loan. If you do this, your profit will be increased. This is the meaning of leverage. So, this is the operating leverage. We can calculate it by gross profit divided by earning per share, earning before interest and tax. This is the operating leverage. And the financial leverage, which equal EBIT divided by earning before tax. And by multiply this, it gives me compounding leverage. We'll take an example to see the effect on these three types of leverage on what? On earning before purchase. Before I start, you have to know that the cost, we have two types of cost. We have variable cost, which means by increasing the number of sales, this type of cost must be increased, because this is the cost of per unit. And we have fixed cost, which means by increasing the number of units, this cost remains the same without any change. Okay? Okay. Okay. So, if we have an example with this information, if we have a number of units sold equal 2,000 units, and the variable cost per unit equal $30, and the selling price per unit equal $150 per unit, and the total fixed cost equal 100,000, and the interest, this is how can I calculate the interest? By multiply the total value of debt, multiply the interest rate. We have 70,000 as an interest. And the tax rate equals 30%. Number of shares we have equal 10,000. Now, how can we calculate the three types of leverage? To calculate this is what we have, okay, we can prepare the same, income statement by multiplying the number of units, multiply the selling price, give you the total sales, variable cost, number of units by variable cost, it gives you the cost of goods. The remainder, by deducting this from this, it gives you the cost, the gross profit, minus the fixed cost, it gives us the EBIT, minus the interest, it gives us the earning before tax. By taking 30% from this value equals the tax. So this is the net income. By dividing the net income divided by number of shares, it gives you the earning per share. Please don't forget this number, because this is our main drive today. How can we increase this value? Earning per share. Okay. How can we calculate the operating leverage, financial leverage, compounding leverage? The first way, as I mentioned before, you can use your income statement. Gross profit divided by EBIT, it gives you operating leverage, which equals 240 divided by 140 equal operating leverage. By taking the value of EBIT divided by earning before tax, 140 divided by 70 equal 2, this is the financial leverage. By multiply those to each other, it gives you the compounding leverage. Okay? I will explain in details. We have many ways to calculate the degree of operating leverage. As I told you, by gross profit divided by EBIT, 240 divided by 140 equal 1.7. What does it mean? I will explain. Or we can use this equation. Operating leverage equal number of units multiply the price per unit minus variable cost divided by same value minus the total fixed value. So as I mentioned at the beginning, that the main drive for the operating leverage is what? Is the fixed cost. Okay. 2,000 multiply 150 minus 30 divided by 2,000 multiply 150 minus 30 minus 100,000, it gives us 1.714. This means what? If I change the sales by 100%, if I double my sales, my EBIT will be increased so by increasing only 100%, my EBIT will be increased by 171%, more than increasing on sales. Okay. Financial leverage. Remember, the financial leverage affected only by what? By interest. So, it is equal EBIT divided by earning before tax. EBIT was 140,000 divided by 70,000 equal to, or by using the equation, number of unit multiply the price per unit minus variable cost minus fixed cost, which is what? Which is the denominator of operating leverage. This is divided by what? Divided by number of unit multiply price per unit minus variable cost minus fixed minus interest. The only difference between those is what? Is the interest value. So the main drive of the financial leverage is the interest, yes. Okay, so by calculating this one, it is equal to the same value as this one. What this means? If we increase our EBIT by 100%, our earning before tax will increase by 200%. Wow. Compounding. Compounding is the multiplication of the two degrees of leverage. So compounding leverage equals the operating leverage multiplied by the what? The operation leverage multiplied by financial leverage. Exactly as this equation. Okay. So degree of compounded leverage. Okay. This one. If you are going to use the income statement, you have to take the gross profit divided by earning before tax. By equation, please highly concentrate. It will be what? Number of unit multiplied price per unit minus variable cost divided by number of unit multiplied by price per unit minus variable cost minus total fixed cost minus interest. Okay. It gives us how much? It gives us the same 3.43. A huge. And the third way to how to calculate this one, by multiply operating leverage by financial leverage, it gives us the same. What does this mean? It means if I am going to increase the sales by 100%, our earning is going to increase by 343%. Huge amount. Okay. Please highly concentrate in this one. This one I'm going to explain it in details now. Assume our sales, remember our sales? Our sales, it was 300,000, as I may remember, 2,000 units. Multiply the price 150, it gives us 300,000. What happened? Now I'm talking about the chairman of the board, or as a financial officer, financial manager in the company. And my aim to increase the earning per share for the owners. So you have to consider in what? Don't forget, we have to consider in EPS. So I need to know what will be happening in our EPS if the marketing manager come to us and telling us we can increase our sales by 50%. If we increase, please don't forget this one. Okay, I will come to this one. This is the old situation. This is our sales, variable cost, gross profit, fixed cost, earning, this is the EBIT, minus interest, earning before tax, minus tax, it gives us net profit. By dividing this one on number of shares, it gives us this value. Please highly concentrate. What will be happened if the sales increase by 50%? Please highly concentrate. If the sales increased by 50%, it will grow from 300 to be 450, which increased by 50%. Variable cost, it will increase by the same. Variable cost, it was 60, by increased by 50%, 50% multiplied 60 is 30. 30 divided plus 60, it will be how much? 90. This minus this, it gives us 360. It grows by the same rate, no difference. Why? It was 240. If it is increased by 50%, 50% multiplied 240, it will be 120 plus 100 plus 240, it will be 360. So in this area, there is no any effect of leverage because you are talking about sales, variable cost, and the gross profit. By increasing the sales by 50, this will be increased by 50, this will be increased by 50. There is no any added value for leverage. Okay, what will be happening? Now, the fixed cost will not increase by the same percentage. So zero increased. This is why the earning before interest and tax, it will increase from 140 to be how much? To be 260. So it is increased by 85%. Don't forget, the sales increase only by 50 and the EBIT increased by how much? 85.7%. Please don't forget this one. How can I calculate this type of increase? The change on EBIT, equal the ending value, it was 260,000 minus the beginning value, it was 140,000 divided by the beginning value 140,000. So this gives us how much? 85.7%. Can I get this change using the idea of leverage? Yes, you can. You can calculate this one, that the delta on EBIT, the change on EBIT, equal delta on sales multiplied by operating leverage, which equal delta sales 50%. This is what we did before. Multiply operating leverage, it was 1.71, I think. For this, if you multiply this by this, it gives you 85.7%. So, if you know this one, if you know this information just from operating leverage, that by increasing sales by 50%, it will increase your EBIT by 85.7%. So easy as a financial manager, when the marketing manager, he said we can increase our sales by 50%. So as a financial manager, you can do what? You can take this value, which is 50%, multiplied by 1.714, which is the operating leverage. It gives you your EBIT will increase by how much? So the old EBIT, it was 140,000. If you multiply this is the EBIT, the new EBIT, huh? The new EBIT equal the old EBIT, which is 140,000, multiply the change with 85.7. If you multiply this by Z%, it gives you 120,000. So the new EBIT, it will be the old one, which is 140,000 plus the change 120. It gives you that the new EBIT will be 260,000. I will do the same for the rest. Okay. So now I can do this. Because the interest will not change, so I will get another benefit for the earning before tax. Earning before tax is 70, it was 70, and now it will be how much? It will be 190,000, which is going to increase by 171%. Please don't forget, we just increase our sales by 50%. Now, our earning before tax is going to increase by 171.4. Come on, I can also calculate this one. Okay, how can I get this one? If you take exactly as we did here. This is the change in earning before tax. How can I calculate the change in earning before tax? By taking the change in EBIT, which is this value, multiply by the financial leverage. It will give you the same, which is 171.4%. So the change on earning before tax, you will get this value, which is the change. Okay. Delta earning before tax equal delta earning before interest and tax multiplied by financial leverage. So this is, it was 85.7% multiply financial leverage equal to, it gives you 171.4. Which means if you have before, go back again, if you have, this is your earning before tax in current situation. If you increase your sales by 50%, this one will be increased by 171.4%. So the new EBIT, the new earning before tax equal the old one, which 70,000 multiplied by 171.4%. This one, it will give you 120,000. So the new earning before tax equals the old earning before tax plus delta, or the change, which is with equal 120,000. So the new earning before tax will be 190,000. So easy and so brilliant. Okay. And if this increased by this one, so by taking 30% as a tax, so it gives me what? It gives me the net income, and by deducting the net income divided by number of shares, it gives you what? It gives you the earning per share. So please, what is the earning per share in this case? Okay, if I know all this information, how can I calculate this one? I'm talking now about the financial manager. The financial manager, if the marketing manager said, we are going to increase our sales by 50%. For me, as a financial manager, I have to know that this is going to increase our EPS by how much? In a second. And don't forget, because I know that the operating leverage, it was 1.7 something, I'm going to multiply this 1.7 multiply 50%, it gives me the effect of operating leverage. And by getting this one multiplied by 2, which is the financial leverage, I will get this percentage, which is now the effect of both, which is the compounding. So, if I know that before increasing the sales, our earning per share it was 4.9, if I multiply this by this percentage, by taking this one, okay, which is what? Which is the compounding, okay, by those two effects. Remember the compounding? What is the compounding? To get this value, compounding, it was how much? It was 3 point something, right? Compounding, it was 3, so the easy way, huh? Now we need to know the effect of the EPS. Highly concentrate. Now, our old earning per share, it was 4.9. The marketing manager, he said that our sales is going to change by 50%. For me, in a second, I need to know how much is the value of the earning per share. What you can do as a financial manager. In this case, you know, this is take the delta of sales, which is 50%, multiplied by the compounding leverage. It was how much? It was 3.34. If you multiply this by this, definitely, it will give you 1.7, same value, it was 1.71%, I think so. You can do it by yourself, please. It will give you this 1.4. Please, percentage. Take, this is the change, huh? Take this percentage, multiply by this one. So the new earning per share equal the old one multiply the percentage of the change. It gives you how much? It gives you 8.4. This is the delta, huh? This is the delta. Okay. We can call this delta EPS. So the new earning per share, it will be 4.9 plus 8.4, it gives you $13.3. Brilliant. So in this case, by increasing the operating leverage and at the same time increasing the financial leverage, you can maximize the earning per share for your owner of the company. This is a very important 3 types of leverage: operating, financial, compounding leverage. Okay? Thank you so much.